Xtrackers just launched a global ETF with fees as low as 0.07% per year, a total expense ratio that's significantly lower than competing funds by Vanguard, Invesco, SPDR and iShares, which also just launched an ETF covering the same index. Not only that, after digging into the documents, it seems to have even lower ongoing costs than what many believe to be the current fee champion for global ETFs in Europe, the Amundi Prime All Country World. Since the FTSE All World is the one index my wife and I have been investing in since late 2018, first via Vanguard and then an Invesco ETF, I'm very excited about this new development. Having said that, lower fees on paper don't always tell the full story, so let's take a closer look in this video. I'll also tell you if I'm considering switching to the new ETF as well. The FTSE All World Index is one of the most popular ways for European investors to get exposure to the global stock market through a single ETF. It covers around 4,200 large and mid-cap stocks across both developed and emerging markets. So whether the coming decades are dominated by companies located in the US, Europe, Japan, or whether the most innovative, most profitable companies are based in countries like India or China, you own a slice of it automatically. The index, and thus the ETFs covering it, are market cap weighted, meaning the biggest companies by value make up the largest share of the index. This is something that naturally changes on an ongoing basis as companies compete with each other and go up and down in value over time. For me and many other investors on European finance subreddits, the FTSE All World has become what many consider a great one ETF solution to hold over the long run. So much so that you may have heard the term VWC and chill, which refers to simply buying and holding the accumulating Vanguard FTSE All World ETF long term, no matter what is going on in the markets. This popularity is why Invesco launched its own All World ETF 3 years ago, which has grown to a fund size of $4.3 billion since then. And now there's a new player in the game, the Xtrackers FTSE All World ETF, which DWS, the asset management arm of Deutsche Bank and the company behind the Xtrackers ETF brand, launched in April 2026 with yearly fees of 0.12%, which have since been reduced to only 0.07%. 0.07% is the lowest total expense ratio ever offered by an ETF tracking the FTSE All World Index, with Invesco and Vanguard currently sitting at 0.15% and 0.19% respectively. The recently launched iShares FTSE All World ETF also has a higher expense ratio at 0.12% per year. Xtrackers somehow managed to match the low yearly fee offered by the Amundi Prime All Country World, which tracks a lesser known index, the Selective GBS Global Markets, rather than the FTSE All World. Since Selective charges lower index licensing fees on average compared to FTSE or MSCI, something I covered in another video 9 months ago, I'm impressed that they managed to achieve this. And Xtrackers isn't a small or unknown asset manager. With around 300 billion euros in assets under management, they're one of the largest ETF providers in Europe. So this isn't the case of artificially low fees just to grab attention. Speaking of low fees, you can find my favorite low-cost brokers in Europe for ETFs linked down below, which is a great way to support me if you'd like to. Okay, now let's take a closer look at how it compares to other global ETFs across a few key criteria. First, we have the total expense ratio, which we already discussed. At 0.07%, it's the lowest on this list of physically replicating global ETFs, together with the Amundi Prime All Country World. But as I mentioned at the start, fees on paper don't always tell the full story. I went through all the key information documents for each of these funds, where you don't just find the total expense ratio we just covered, but also an estimate of internal transaction fees per year. These are the costs an ETF incurs internally when buying and selling stocks to keep up with changes in the index. When you add the estimated yearly transaction costs to the total expense ratio, here's what the picture actually looks like. The new Xtrackers FTSE All World actually seems to be around 0.02% cheaper than the Amundi Prime All Country World overall, which is now matching the SPDR MSCI All Country World, whose transaction costs are so low they round down to zero in its official document. Keep in mind that transaction costs can vary on a year-to-year basis. Even still, I found it interesting to see how things change when you include this number as well. And it sadly also shows that Vanguard still has a lot of catching up to do on fees with the competition in Europe. Now, the TER and internal transaction costs tell you what a fund charges, but there's another metric that actually matters even more in practice, the tracking difference. This is the gap between index returns and ETF returns after all internal costs and including any income funds generate from securities lending, which can further boost an ETF's performance. Existing global ETFs by Invesco, Vanguard, Amundi, SPDR and iShares have had a good track record here, with a tracking difference that's very close to the index and sometimes even beating the index performance. In case you're wondering how an ETF can beat its index at times even after fees, here's the primary reason. The index return numbers assume a worst-case withholding tax of 30% on dividends paid by US stocks, but ETFs with a fund domiciled in Ireland are actually able to reduce this to only 15%. And since US stocks currently make up around 60% of global ETFs by market cap, the lower withholding tax can lead to an ETF outperforming its underlying index. Now with the new Xtrackers FTSE All World ETF, we simply don't have enough data yet to properly judge its tracking difference. After all, it was launched only 2 months ago. What I can say is that Xtrackers has a solid track record with its MSCI World ETFs in this regard, which is an encouraging sign. Still, we should probably wait a year or two before we can say anything meaningful about this specific new ETF. Next, we need to talk about its fund size and the resulting closure risk. Vanguard's accumulating FTSE All World ETF currently has around $46 billion in assets under management, making it one of the largest ETFs in Europe. And Invesco's version has grown to almost $4.4 billion since launching only 3 years ago. This shows there's clearly demand from European investors for ETFs covering this index. Since Xtrackers' new ETF is currently only 2 months old, its fund size of around 35 million euros is still very small by comparison as of today. If a fund stays below a certain size, generally around 100 million euros, there's a risk the provider may decide to close it at some point, as it may not be generating enough revenue to cover its operating costs. Just to be clear, even that's not the end of the world. It simply means the underlying stocks are sold and the money is returned to you. But it can still trigger an unwanted taxable event, forcing you to realize capital gains earlier than planned. That said, given Xtrackers' reputation and the clear demand for a cheaper FTSE All World option, a closure seems unlikely in my personal view. Still, it's a risk worth being aware of, especially as long as the fund size hasn't crossed into the hundreds of millions of euros. Which brings me to another downside of investing in a newly launched ETF, the spread. No, I'm not talking about this kind of spread. I'm referring to the difference between buying and selling prices you see on exchanges. You've probably noticed this already if you've ever bought an ETF or stock using your broker of choice. The buy price always tends to be slightly higher than the sell price. This gap is called spread, and it represents an additional cost each time you trade. Spreads tend to be minimal for larger, more established ETFs, but they can be quite a bit higher with smaller ones. Here's recent live data I recorded from the GetEx exchange to show you what I mean. While Invesco's and Vanguard's All World ETFs were showing extremely tight spreads of only 0.01%, the new Xtrackers ETF had a spread of around 0.1%. That's about 10 times wider. Now, this spread is a one-time cost. It only affects you whenever you buy or sell shares, not throughout your holding period. But it's worth being aware of when comparing ETF fees. Now the good news is I've seen this before and it's completely normal. When Invesco launched its FTSE All World ETF 3 years ago, spreads were also higher in the beginning and then shrank more and more as its fund size and trading volume increased. So with time, this particular downside should take care of itself. If you'd like to take a closer look at the ETF yourself, you can currently find the Xtrackers FTSE All World ETF using the ticker ALLW on a few brokers I checked. On Interactive Brokers, traded directly in euros via IBIS, meaning the Xetra exchange, and on the German broker Scalable Capital. Meanwhile, on Trade Republic, it only seems to be available for investors based in Germany for now. That might change as it's likely to become more readily available over time. Now you may be wondering, am I considering a switch to this new ETF with my monthly savings? After all, its total expense ratio is 0.08% lower than the one I'm currently buying, which I'd argue is quite the achievement for an ETF covering such a broadly diversified, well-known stock index. Well, at least for now, the answer is no. Here's why. I'd first like to see its fund size grow, its spread tighten as a result, and I'd like to give it at least a year to see if the lower fee translates into an attractive index tracking difference. There's also another reason. Here in Austria, Invesco ETFs have generally been among the most tax efficient throughout the holding period, which is something else that I look for in my ETFs. That aspect is completely irrelevant if you're based in any other country though. But regardless of which ETF you currently hold, I believe that this launch is great news for all of us. The fact that Xtrackers is able to offer this ETF with a total expense ratio of only 0.07% is likely to put pressure on competing fund issuers to continue lowering theirs as well, which would benefit us European investors across the board. Now I'd love to know in the comments, what do you think about the new ETF? You can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to, apart from gently typing the like button and subscribing, of course, if you haven't yet. As always, nothing I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you so much for watching, have a wonderful day, and until next time.